We're about to tackle a question that seems, pretty simple on the surface, but has a really mind-bending answer. Where does money actually come from? I guarantee you, the truth is probably not what you think. So let's dive right in and uncover it. So let's start with that big question. When you think of money, what's the first image that pops into your head? Is it a giant printing press just churning out bills? Or maybe a government vault stacked high with cash? Well, hold that thought, because we are about to completely flip that idea on its head. Okay, this gets right to the heart of it. The common myth, the one we all kind of grow up with, is that governments print all the money. But the reality, the vast majority of money in our economy is created by commercial banks every single time they issue a loan. Just let that sink in for a second. So if it's not the government, then who are these real money creators? Well, the scale of this is pretty staggering. Get this, over 90% of all the money in the economy exists only as digital numbers in commercial bank computers. That tiny little slice left over, that's what we call central bank money, which includes the physical cash you might have in your wallet. So the big takeaway here is that most money today is digital and it's born from debt. So how does this magic trick actually work? I mean, how can a simple bank loan create brand new money? It sounds totally impossible, right? But believe it or not, it happens every single day. Let's walk through it, step by step. It all starts pretty simply. Let's say you deposit 10,000 rupees into your bank account. The bank then turns around and issues a loan for, say, 9,000 rupees to another customer. But, and this is the absolute key, they don't take that 9,000 from your account. They just type the numbers into the borrower's account and poof, just like that, new money is created. And this is the part that feels like actual magic. Your account balance hasn't changed a bit. You still have your 10,000 rupees. But now another person also has 9,000 rupees that literally did not exist a moment ago. Both of those amounts of money exist at the same time. The loan created new purchasing power, essentially out of thin air. And here is the result. We started with 10,000 rupees, but after just one loan, the total money supply in the system has expanded to 19,000. Now imagine this process repeating itself over and over. That new 9,000 can be deposited in another bank, which then becomes the basis for yet another loan, expanding the money supply even further. Now, of course, you're probably thinking, can banks just do this forever without any limits? Well, no. There is a whole system that governs this process, and it provides the framework for our entire modern economy. This system has a name. It's called fractional reserve banking. It basically requires banks to keep just a fraction of their deposits in reserve. The rest can be loaned out, which, as we've just seen, creates brand new money and expands the money supply. This is the very engine that powers almost all of our economic activity. But what's really fascinating is that this process also works in reverse. So if issuing a loan creates money, what do you think happens when it gets paid back? Well, when you repay the principal on your loan, that digital money is effectively destroyed. It vanishes from the system just as magically as it appeared. Now, it's super important to clarify one thing here. While the principal, the original loan amount, is destroyed when you pay it back, the interest is not. The interest you pay is the bank's income for providing the service and, for taking on the risk. That money stays in the system as the bank's profit. Okay, so we've got the mechanics down, but why does any of this really matter to you and me? Well, because this whole system of creating money through debt has some really profound consequences for economic growth. And, as you might guess, it comes with some significant risks. So, on the one hand, this credit-based system is what makes our modern world possible. It's what allows businesses to invest and grow, people to buy homes and cars, and governments to fund huge projects like roads and hospitals. You could say it's the grease in the wheels of the economy, letting us use future earnings today. But it is a very delicate balancing act. There are major risks on both sides of this equation. If banks lend too much, they can cause runaway inflation and create huge asset bubbles. But if they lend too little, the money supply actually shrinks and the economy can fall into a recession. It's a real tightrope walk. If you take away just one single thing from all of this, let it be this. In our modern economy, money and debt are basically two sides of the same coin. You really can't have one without the other. Our entire financial system is built on this deep, fundamental connection. And that leaves us with one final, pretty provocative question to think about. If new money is only created when someone goes into debt, and old money is destroyed when that debt is repaid, what would actually happen to our economy if we all just decided to stop borrowing?
It's a question that really reveals just how fragile and how incredibly dynamic this whole system truly is.